It's actually the fourth Thursday that I'm correcting myself. So this month it is March 27th. Happy hour. It's a very casual event. It's basically just conversation together, socialize. On the second floor, make opinion, drink is great. 5 to 7. Casually outside of this. In-person event. It's going to be a CLE here at the offices is on April 23rd. It's called Creating a Record. We're going to have the Colorado Court reporters come and present to us. That's going to be, again, starting at 11:30 as well. Please try to make that event if you are a litigator. As you may be able to tell from my pattern of speech, court reporters hate me because I talk too fast. So I will be here to learn from them, and hopefully you all will be able to join us as well. Finally, I'm putting a save the date here in your minds. We've got our big event for Law Day coming up in May. It's going to be on May 8th at the Pinery from 4:30 to 8 p.m. It's a very fancy, swanky event. It's a lot of fun. Hopefully you all will be there. Again, that's May 8th starting at 4:30 p.m. Now, without further ado, let's dive into our presentation today. Today we have the honor of being presented to you by Marcelino Dodge. He is an EA, a CTRC, and owner of Cash Tracks Financial and Panther Tax Resolution. He has over 25 years of experience in tax preparation and is the owner of Cash Tracks Financial and Panther Tax Resolution. He received his Bachelor of Science degree from CSU Pueblo, and he's an enrolled agent, otherwise known as an EA, which means he's authorized to represent clients before the IRS. He's a member of both the National Association of Tax Professionals and the the Tax Representative Network. Marcelino is committed to providing expert tax services. Rated A+ by the Better Business Bureau, he also hosts the Tax Answer Advisor podcast, sharing valuable insights on navigating complex tax issues. And I found out he's going to be presenting on Fox News next week about these very important tax topics. So please welcome me to joining Marcelino Dodge.
Are we unmuted yet? Well, first of all, I want to thank you all for even allowing me to come. I appreciate the opportunity to share this subject. And just a little bit, I mean, she told you all that already, so I don't need to go through it again. But something that's not here that I like to share with all is that I was not a tax person out of college. It took me 10 years to discover my calling. I did a lot of businesses afterwards. I did sales, I did insurance, all kinds of different things. So unlike some tax people who tend to ramble, I may ramble too, but I have a very different perspective on tax preparation, as a lot of people, a lot of other tax professionals may not have. So because I've been a business owner, and I am a business owner, but I was a business owner outside of tax. Then I discovered my calling of doing tax. So anyway, just kind of give a little bit more about me, so you know kind of where I'm coming from. And also, my bachelor's degree is not in accounting or tax or anything either. My bachelor's degree is in mass communications with an emphasis in radio and television broadcasting. I thought I was going to be a broadcaster one day, but it didn't turn out. But I have found those skills very useful as I've learned the tax business over the last 25 years and became an enrolled agent. It's allowed me to be able to come in and do presentations like this because I have done the radio and those kind of things as well. So anyway, just a little bit more about me. I guess you can see I'm bragging a little bit, but I'm also very happy with what I've done and how I've gotten to where I am. So anyway, today's purpose is to help you, as I mentioned there, get some key tax considerations that can affect you. Now, as an attorney, I used to have this weird thing about attorneys, like most people do. But then after I sat and thought about this and doing this presentation, I'm like, you're business owners just like the rest of us. You just have a different specialty. Now, in your specialty, there's different considerations, because whenever you go and do a tax, when I go to prepare a tax return, I still get to know that person's business, because each business has its nuances. And just like yours has its little nuances, little different things about it, but there's also tons of similarities when it comes to tax rules and tax laws. And so we're going to talk about that, as well as I'm going to touch on some considerations that affect your clients. So some of you may be involved in various family court cases and so on. Now, 90% of the time, 95% of the time, 96% of the time, 97% of the time, 98% of the time, 99% of the time, 100% of the time, 2% of the time, 3% of the time, 4% of the time, 5% of the time, 6% of the time, 7% of the time, 8% of the time, 9% of the time, 10% of the time, 11% of the time, 12% of the time, 13% of the time, 14% of the time, 15% of the time, 16% of the time, 17% of the time, 18% of the time, 19% of the time, 20% of the time, 21% of the time, 22% of the time, 23% of the time, 24% of the time, 25% of the time, 26% of the time, 27% of the time, 28% of the time, 29% of the time, 30% of the time, 31% of the time, 32% of the time, 33% of the time, 34% of the time, 35% of the time, 36% of the time, 37% of the time, 38% of the time, 39% of the time, 40% of the time, 41% of the time, 42% of the time, 43% of the time, 44% of the time, 45% of the time, 46% of And some of the areas I'll touch on too will be where there's conflicts. What are these conflicts? There's conflicts between what the IRS tax code is and the federal law is, and what the Colorado revised statutes say. And so who wins in those situations? From the IRS, I'm going to give to you from the IRS standpoint, is what I'm going to tell you on there. So as it says, income tax reporting and recognition for you, deductible expenses, how do you track it? Some of you may need assistance with that. Entity selection for tax purposes, that's very important. Any type of business, what type of entity are you going to be? Because that also affects all your tax considerations. Filing status during divorce, what's that going to be? The claiming of the children. I'm going to touch on all, it's all going to be related to tax. How does the tax part come into it? And once again, that's part of the conflicts I mentioned. Often it comes in with claiming of the children. Who's going to claim what? Because Colorado says one thing, federal law says another thing. Known and unknown tax debts. This gets also into divorce situations where I'll give some actual real life cases or examples of I've had to deal with where there's been tax returns filed by one spouse and the other spouse knew nothing about it. And then you had to go back, in and clean up the mess. So that's after a divorce or after a death or something of that nature that happens. But there are tax codes and tax remedies for such situations. Now, when is income reported? Well, first question is, are you a cash basis or accrual basis taxpayer? These are accounting terms, not obviously legal terms. So most small business people are cash basis taxpayers, which means revenue is recognized when it comes in and expense is recognized when it goes out. Some of you will get a retainer upfront for certain services that you'll bill X amount. You'll get $5,000, you'll bill X amount per hour as you work on the case. But when do you recognize that? If you're a cash basis taxpayer, that you take right when you get that retainers when it is income to you. You're just subtracting it off their hours. If you're accrual basis, which this is, you usually make the choice when you get started. The vast majority of people I work with are cash. Most accrual-based taxpayers are would be like a very large firm, probably. If we're dealing with mainly small firms, a few people or a couple partners or whatever, you're probably going to be cash-based. But accrual basis, as it mentions, if you happen to be that, it's when the income is earned. So yeah, you can get the $5,000 in, but as you bill out like $500 an hour for the services, then you start recognizing it as income if you're accrual basis. And as I mentioned there, I put IRS section 451, which states that it applies to retainers. So, oh, also, if you have a question, I'll take limited questions during the presentation, then we'll have an opportunity at the end as well. So, and just like, yes. Correct, if you're a cash basis taxpayer. Because all you can essentially comes in as income, and then you're just transferring it from your trust to your operating. But it's yeah, I understand that. But for income tax purposes, it's considered income by the IRS, even though it's in your trust account. I understand your concern and your question, but when it comes in cash basis, it's when you receive it, not when you put it to your operating account. This is all it's IRS in the IRS code section. I get exactly what you're saying, and you know, I sit there and I should tell people stuff in various when I meet with clients that they're like, "What?" I'm like, "That's what the tax code says. That's what we're stuck with." So you're just that's just yeah. Even if it's in your trust account, it's still income, unless you're an accrual basis taxpayer. Then it becomes income as you bill it out and move it over. That's the difference between the two types of, so like I said, everybody's situation is different. You don't have to be a cash basis. You can be an accrual basis, which takes care of what you're talking about. But it all depends. It's all on how you do it. And you can elect to be an accrual basis taxpayer. I mean, I'm saying anybody can be an accrual basis taxpayer if they choose. If it's in your best interest as a tax, for tax purposes, it can be done. So it's it. So yeah. So anyway, answer to your question there. I wish I had a better answer for you, but that is the answer. Okay, deductions. Whoops, too far. Oh, where'd we go? Okay, deductions. Now, it depends. The mileage and the office really depends. Depends where your office is. Some of you may have an office in the home. So if you have an office in the home, you have a part in your home that you're exclusively using for business purposes. When you leave your home, go to court, go to see a client, or whatever you're going to do, you can track that mileage. I usually have my clients use an app called Mile IQ, which puts out a very nice report between business and non-business mileage. If you have an office, like in this building or somewhere, you have to get to the office first, because going from your office or from your home to your office is called commuting. And that's not a deductible expense. But when you go to your office and you're going to court or wherever you may travel to do research, then you can do the mile. Now, as I mentioned as I got mentioned, the S Corp may qualify for reimbursement. So under certain types of entities that you may be able to not, instead of deducting it, you may be able to reimburse yourself for it, but it really depends on the type of entity that you are. And I'm going to talk about entities in just a moment here. Then office at the home, once again, exclusivity required. So if you got that space in your home, that's all you're doing. It's all you can do in that. There is a deduction there for the office in the home. Now, in the office in your home, there's an as cost one, and there's also a, oh, I hate it when it escapes me like this. Anyway, there's like a basic one that you can take that won't be audited, but then there's standard. There you go, standard. Standard is like a standard deduction they can give you based on square footage, and there's an actual cost one they can give you. You can take either one, and you can actually jump back and forth each year. But depending on a lot of circumstances, which one's better, I don't know. This depends on the numbers each year. So that's what I do. I look at each of the numbers, and then we decide what's best for the client. But if it's the standard one, it's not likely going to be audited because it says we're just taking that, so they're not going to look at it. Research, of course, you spend money on research. If you're anything like me, I spend money on research, on tax codes, on finding various areas related to my clients. You probably spend money on research as well. Whether you pay somebody to do the research, maybe you're using an AI tool to help you with research now, which I'm discovering in the tax business is very handy. There, yes. Mm-hmm. A tool you use, I would probably say you can either do it as research or as a subscription. I would probably use it either way, but you could definitely use it in one of the areas. So, and then meals, of course, you buy meals for clients for treat. You can take some meals off. Office supplies. I mean, some of this is just general stuff. Office supplies, utilities, advertising. I mean, I don't know how many of you have like the billboards that some attorneys put out there like crazy, or whatever method you may use. And this includes like various forms of online advertising. If you're doing advertising through social media or some other means, that's all wrapped up into that. And of course, insurance, various types of insurance. If you're paying employee wages, if you're doing any benefits, of course, and that if you're a certain type of entity, that could be your wages too. That's the only time the wages can apply. Then, of course, licenses, professional education requirements. Just as you have professional education requirements, I have professional education requirements as well, and all that's right up as you go. There's a few more. These are just some highlights of what you can, but each of your situations is different. I mean, even as attorneys, each of you have a different situation, and so what's best for you may not be best for another colleague. That same thing go across in the tax business. Entity selection. Are you going to be a sole proprietor or single member LLC, partnership, or multi-member LLC, S Corp, or whatever? Single member sole proprietorship or single member LLC is essentially the same thing for tax purposes. That's just the way the IRS took the LLC and said, you're a single member, boom, you're going to be taxed as a sole proprietor. So I know a lot of people I do a lot of companies that are single member LLCs. And when I go and explain to them, wow, I have an LLC and they give me all the information. I'm like, well, okay, this is how you're taxed. Essentially, you're self-employed and you pay self-employment tax. And your tax as a sole proprietor. You're not a sole proprietor, but you're taxed as one. And so all the deductions I mentioned earlier there, if employees, all that falls within there. Difference being that you pay tax on the net profit of the business, of whatever's at the bottom of that Schedule C. You pay that. So, and of course, great part about being a single member LLC is that you can just essentially play with the money any way you want. Because it's just there, you're taxed as a sole proprietor. So as you take the money out to go take care of business or just for personal expenses, no big deal because you're taxed as a sole proprietor. You get into the partnership or multi-member LLC, which I know some firms do that. It's a little bit different. You got to make sure you have a separate business account, which I write even in the sole proprietor single member LLC. I always recommend a separate business account. Because and I try to avoid commingling funds. If you need money, just do a single transfer from your business account to your personal account, but keep them separate all the time. As a general rule, I always recommend. Then if you're in a partnership multi-member, it is absolutely essential that you keep things separate. Now you still as a partnership or multi-member, you're still considered self-employed, which basically once again means you can't be an employee. And I've seen this, and this is actually in the tax code, that if you're, I don't know why some accountants, I don't mean to talk bad about accountants and tax people, but sometimes they'll do things and have LLC members be employees and they're still taxed as a partnership. That's a big no-no in the tax code. Now, I don't do those tax returns. I will not do those tax returns. And I will tell people that, look, whoever does the partnership tax return, that's their problem, not mine. So, but I'll warn them. Okay. So anyway, so you got to be separate because in a partnership you can get, or when your partnership, multi-member LLC tax as a partnership, however your agreement's set up, you as a member of that, you may get for services rendered, you could get what's known as guaranteed payments, which is a certain amount you can get for services rendered. And there's certain other areas that fall into there, like maybe some benefits and stuff that you may be able to get as a member, but it's you got to be very careful with how they're set up. Now, if you go in, now, fun part is you don't have to be a corporation to be taxed as a corporation. What I do a lot of in my clients, I have multi-member LLCs that are taxed as S corps. How can I'm a multi-member LLC? I'm taxed as a partnership. How can I be taxed as an S corp? We make an election. And what does that do if you do that? Well, like I say, I don't know if it's good in your situation, but this is an option. You make that election. What happens then, you go from being a member that's self-employed to like a shareholder who can be an employee of the business. Now, what's some of the benefits? The benefits is that, of course, you become an employee. You don't pay self-employment tax. You get a W-2 at the end of the year. Plus, you can have the company pay for more benefits for you directly as well in that respect. And when you're dealing with a partnership or sole proprietor taxation, well, you pay in self-employment tax, none of that is deductible. Zero. You make the S corp election, your wages become a deduction to the business. The match, Social Security and Medicare matching that the business does is a deduction to the business. Now I mentioned here, must take reasonable compensation before distributions. So you still need to, you can't, what that's meaning is that you can't have a business making like $100,000, for example, and you take a check only of like $25,000. You have to have reasonable compensation, and there are methods to determine what reasonable compensation is. One way to think about it is how much would it cost to replace you? To have another attorney come in and take your spot. That'll give you an idea of what reasonable compensation would be. Now, once that reasonable compensation standard is met, then you can take distributions out of the business as a shareholder of the business. And the S corp election can apply whether it's a single member or multi-member LLC. You can take the distribution. So basically, if, for example, if in your particular position, your company makes $200,000 and 80,000 may be reasonable compensation on your W-2. You can take another 100,000 distributions and just pay regular income tax, not self-employment tax. That's the difference between the S Corp and the partnership. I'm just saying this is the advantage of it. I don't know if it's best for you or not. I'm just saying this is the possibilities, the reality of what's possible. Because you don't have, and then a C Corp, usually we stick away from those in the case of attorneys because it mentions subject to personal service corporation rules, which is a whole other set of rules I don't want to get into because they're rather complicated and kind of get stuck in some flat tax things. And you can be subject to double taxation as well. That's usually why we avoid those. Although in some cases could be applicable, but I haven't found one yet where it fits in there. Retirement benefits. Also, this is where the difference in entity plays in, is in retirement. Is each of these type of retirement plans, basically you can do in any of what I just mentioned. You can do it to tax as a sole proprietor, you can do a tax as a partnership, you can do a tax as an S Corp. The difference is how the deductions apply. If you're basically, if you're a sole proprietor, none of these reduce self-employment tax because they all show up as what they call an above the line deduction on the tax return. In the partnership mode, there may be some limited benefit here. Some limited deductions come with them, but in the S Corp, you get the full deductions. Whether it be an employee, a deduction from your check as an employee. See, this is a good way you can do it. You can maximize when you're an employee like in an S Corp, you can raise your salary, maximize your 401k, and still have a decent salary at the end. And have the company match it and pay for it. And that's an additional deduction for the company. Which basically, what I like to have my S Corps do is have them as close to zero profit at the end of the year as possible. And although if you make money, that's great. You can take a distribution, just pay the income tax. Maybe you have to pay estimated taxes, but it would be good just to be aware that what you select as the entity affects a lot of areas. Now, that doesn't mean if you started off as a sole proprietor or whatever, doesn't mean you can't change. Or if you're a partnership. See, as a partnership, if you've been a partnership for a few years, or multi-member LLC tax as a partnership for a few years, you don't have to stay that way. There can be some adjustments, but you can make an election at the beginning. In fact, where are we? We're in March. Well, we have just a few days because March 15th is the deadline. You can actually make an S Corp election to begin this year if you chose to. Here's the funny part about that too, is that even if you missed the March 15th deadline and you have a tax person who knows what they're doing, you can make a late election. Like in June, July, August, and say, I want to be an S Corp as at the beginning of the year. You can do that as long as you've been acting that way. No, 2025. Yeah, well, I don't think we can go back to 2024, but I would do it as of 2025. So say if you go through the year, and you're basically doing business like it anyway. You get into July, you're like, oh man, I missed the deadline. What can I do? Well, you can. There's what's known as late election relief, and there's a good chance you can get it back to January 1st. But you can actually elect to change anytime during the year. I mean, you can be in July and decide to change as of June 1st when you make the election, but usually we like to keep it on calendar year. I had a gentleman last year that I worked with who came to me in July thinking he had done everything right. I said, well, no, I went through his paperwork. Nope. We made the late S Corp election, filed the S Corp return, did everything according to the rules. He got his S Corp election effective as January 1st, 2024. So it does happen. I've done it multiple times. But like I say, it's what each business's needs are as to what we do. Each individual business is their own business, and so we have to do what's best for them. And so now, of course, I mentioned you can still do traditional Roth IRA up to April 15th. And you can do that for your spouse as well. Because if your spouse doesn't work, for example, you can make a contribution for them as well. Because their earned income is considered not only your earned income, but also your spouse's earned income. So you have that available. Plus there's catch-up contributions that you can make as well. So there's a lot going on here. And depending on what you're doing and where you are, you may be able to do both a retirement plan contribution for your business, like a simple SEP or 401k, and a traditional IRA and an individual IRA. Why? Because the first three are business plans. The bottom one is individual. And so you can actually kind of double up a little bit. I've had clients do this and it works just fantastic. So, but if you're doing the top three, one of the top three, I usually suggest doing a Roth on the bottom, maximizing a Roth. That way some of your future income is tax-free based on current law. And if they ever did change it, you'd be grandfathered in. So just some great thoughts to consider. Let me see here. So yeah, deferral limits, catch-up provisions for if you're 50 or over. And then they just added something if you're 60 and over as well. Some of the new plans out, so really let you play catch-up. Now, some of these areas here, that's all in your area. Now I'm going to get into touch on some of just a few things here. Divorce cases. I've dealt with a lot of tax issues in divorce cases that come up. Individuals who have divorce decrees written out by the court, and there's really some unusual things in it. But anyway, first of all, filing status, because I got people who just recently got divorced, but hadn't lived together in years. And I'm sure you've encountered stories like that. But how do they file? How are they supposed to be filing all that time is one question. Because it says living apart, one may qualify as head of household. But how can they qualify as head of household? There has to be a qualifying child in the home. But if one files as head of household, how's the other one supposed to file? They're still married filing separately, according to Internal Revenue Code Section 1. You're still, and this is where I've seen tax people. I used to make this mistake, frankly, but I was like, oh no, I can't do that anymore, so I quit doing it. Is that married filing separately, even if they're not living together, and one files head of household, the other one still has to do married filing separately. Now, if the other part is what's their filing status according to court? What's the courts do? Sometimes they file if the divorce isn't final on or before December 31st, they're considered married for the whole year. So those are the two options unless they qualify for head of household. I have run into parts where things actually got settled shortly after the beginning of the year, and the court, and it was with the IRS code. It went to the IRS code where they said for them to file jointly. And so we did. But in those cases, it worked because it wasn't detrimental to either party. Because you could run into some cases where you're doing married filing joint, and it could be detrimental to one of them getting divorced, and it may not be the good thing. And why is that? Well, because married filing jointly makes both of them liable for the tax. And that's where issues can come up, and some that I'll talk about just a little bit more as well. Now, of course, the other side up when you come to divorce are children. Children are always a thing. This is the biggest challenge for me as a tax professional, dealing with children of divorce, because there are individuals who I can't think of a better way to describe it from a tax standpoint. They see their child as a big dollar sign. That's how it comes across to me, the way they act. Because they're just bound to determine, I'm going to claim this child or whatever. Now, oftentimes children living with parents, who does the child live with? As I mentioned there, Internal Revenue Code, Section 52, 183 days. One of the biggest issues I run into in divorce decrees, and as a tax person, is it doesn't really say how many days. It says this many days here, this many days here. Sometimes it doesn't even really designate who the custodial parent is. The IRS gives priority to the custodial parent. So then I'm dealing with this little shuffling game, trying to figure out who really can claim the child. Now, oftentimes the decrees do say in odd years this parent claims, in even years this parent often says that. But in many cases, it does say one of the parents is the custodial parent. Sometimes it says it, sometimes it don't. I've seen it both ways. That's where it gets confusing for me as a tax professional, and where it'd be good, at least for them on a tax standpoint, to have someone designated as custodial parent. Even though they may have 50-50 custody, sometimes the child usually does stay with one of them more days during the year, which I'm saying 183 days or 183 nights. That's the one that, as they say, wins the prize of claiming, at least from the IRS standpoint. There. Now, as I mentioned, who is the custodial parent? Now, this part here is important because, as I mentioned there, the form 8332. I thought I put it on there. Anyway, that's a form that I've seen it actually designated in some court documents. I've seen it once or twice in court documents. Because that is, by the way, you hear me mention court documents a lot. Whenever I hear a divorce has happened and children are involved, I always ask my client for the divorce document. That is a requirement of me as a tax professional. That's what I personally require in my office, is to have that document. I think we have the same opinion sometimes. We do not trust our clients. I think in a way as professionals, we feel that way. So I ask them for the court document. And then sometimes I have to explain to them, this is what the document actually says. That's what you believe, but this is what the document says. So this is what I'm gonna go by, but I'm gonna explain to you how this compares to what federal law and IRS tax code is. Now, if you have a non-custodial parent, which there are some that specifically say non-custodial parent, and I've seen it sometimes mentioned in the court documents, to have the custodial parent sign that form 8332, which basically that releases the child to be claimed as a dependent by the non-custodial parent. They can sign it once and cover many years, or they can sign it each year. It just really depends. Now, the caveat here, though, on this form is that if a parent signed it for multiple years, the custodial parent can later on revoke it with the IRS. There's actually 3 sections to it. I'm supposed to have a form up here to show you, but anyway, there's a 3rd section on it that says I revoke this election, and they can sign it, and they're done, and it's done. So that's according to IRS publication 501. Now, one of the other areas I encounter a lot is tax credits in regards to divorce cases, is because some parents, especially non-custodial ones, will go and feel that the divorce right here, the parenting plan right here says I get to claim the child this year. Well, yes, that's true. But all you get is a dependent exemption and child tax credit. There's other credits that come in there that don't apply to the non-custodial parent. And getting them, at least from my standpoint, to understand that is, they're like, it's like their head explodes. Oh, I don't get that earned income tax credit? Well, no. IRS tax code says that particular credit is based on where the child resides for 6 months or more, physically present. So and there's a few other credits that fall in there. Oh, well, another one is the dependent, not the dependency, the dependent daycare credit for daycare, because a lot of parents pay for daycare. Well, if you're the non-custodial parent and you're paying for daycare, which, hey, you're given a great gift. You can't take a tax credit for it. They think they can. Oh, I'm paying for daycare for my child. No, because the daycare is actually considered as a convenience for the custodial parent, where the parent lives. That's what it's mainly designed around for when you look at that. So that's why the non-custodial cannot take that credit. There's a few others in there too, but those are the most common ones that I encounter and have to deal with as a tax professional. And in some case, the other things that can get messy are like education credits. If you have students in college, those can get kind of messy too. Another area that can get messy, you're dealing with the advanced healthcare credit. That's another thing that can get kind of messy depending on, you have parent A over here doing a plan through the exchange. They get the form 1095A, they cover their child, and there's a whole gamut in there that goes through that. And all those can get pretty messy in there. And some of that goes beyond the scope of what we're doing here, but just making you aware that there are areas like that it can come, other areas in divorce cases where those can definitely get pretty sticky. You got to just be aware of those issues there. Who's liable for taxes? Who's liable for them? Well, let's see here. Usually both on a married filing joint return, both of them are. But the question is, on that married filing joint return, who was the primary one that created the tax? A lot of times issues coming in this is you have one spouse that's working for a W-2 employer and another spouse that is self-employed, that has self-employment tax. And they made a lot of money and they spent it all. They don't have anything to pay the tax. That's where a lot of it comes in. That's where I've encountered a lot of it, is on that end. Did one spouse earn most of the income? In some cases, yes. Where is that? Did spouse A file tax returns without the knowledge and consent of spouse B? Maybe you've heard. I've encountered this a lot. That happens, especially in this electronic filing age we're in. It's very easy to have someone, and one of the cases, in fact, one of the first cases I worked on, a gentleman who was self-employed, had self-employed income, filed a tax return with him and his spouse. His spouse had no idea about it. Later on, what happened, the one that did the filing without his spouse's knowledge got 1099s for DJ work that he had done, got a bill from the IRS for unreported income. I didn't see what the amounts of 1099s were, but the result of that was the fact that they had made claims for things like earned income tax credit, child tax credit, all these things. And it wasn't so much the self-employment tax that hit. It was the fact that because those 1099s raised the income so much, the earned income credit, they were calling it back. And we're talking $4,000 or $5,000 at the minimum, plus penalties, plus interest. And then the self-employment tax on top of it. So I had this now ex-wife come to me and say, and this is somebody I didn't know personally, by the way, so I'm very aware of the situation of what was going on. She came to me with this bill and everything, and I'm going, he did what? I thought I knew this guy. Anyway, we were able to go through, explain. That gets down to the difference between injured spouse and innocent spouse. In this particular case, this ex-wife at this point would be an innocent spouse, because she didn't create that liability. Actually, because she was a stay-at-home mom. So she didn't create self-employment tax. She didn't create any of it. She was just a victim, essentially, of a fraudulent tax return, we could say. And so by working through the case, it takes, as you know, with anything, the IRS takes months to get it done. Anyway, we got it through, and we were able to get her what is known as innocent spouse relief. So she wasn't liable for all the tax. Her ex-husband, from my understanding, ended up paying it all at some point, but she was relieved of it because of the circumstances. So that's an innocent spouse. Another case, innocent spouse, I actually had one. This was all self-employment tax. Once again, tax returns all filed without her knowledge. That's oftentimes when that happens. And sometimes it'll come out in divorce, and they're like, oh, I don't know how often you pull tax records in divorce, but if you ever, when you do, you may discover things, especially unfiled tax returns, overdue taxes, these kind of things. Another case, I had a spouse where, in this case, the one who had the taxes died. But yet she, because they had joint filed tax returns, her name was on it. IRS was going after her because she was the living one. But once again, we went through the innocent spouse scenario. I was able to get her tax relief as well through it. Now, injured spouse, that's more actually during the marriage. When you're filing taxes during the marriage. And a spouse, before they got married, has some tax, some federal government obligation. And that's filed with the tax return. And used to cause a tax return to take about 4 or 5 months to get processed, but they've not actually gotten better at that. It usually takes about 8 to 9 weeks now instead of 4 to 5 months. and we had to mail that in several years ago, but we've been able to e-file it there. Yes. Correct. In this day of e-filing and PIN codes of sending in, yes, the IRS can, even if they didn't file the 10. Well, because many times when it's filed, if they use like some online service, some free online service, the IRS takes a PIN code as the signature. And they will hold them responsible because it's a jointly filed return. That's why this innocent spouse relief exists probably, because I've had to do it a few times and it takes time to get done. And they do actually notify the other spouse that this is going on as well when it does happen. Now, there are cases where sometimes when you're dealing with this in spouse, you got to be careful, especially if there's domestic violence involved. There may need, they got to walk cautiously on some of these cases. But other times they know, and it can be done. It can be pretty straightforward. But it's nice to know that if you have someone who has to deal with this, which oftentimes money is a cause of divorce, isn't it? Or money situations or something like that. So taxes can be a big part of it. So that's why it's important to be aware of these situations and have someone you work with to help walk through this portion of it, because it can take months. Dealing with the IRS, it can take months. But at least if you get the process started, like another case I'm working on right now, I had to call the IRS, and I did get somebody, by the way. I called them, I got somebody. I was able to get a 30-day wait on payment as we got some paperwork done. And so see, as mentioned earlier, being an enrolled agent, EA, that's representation or resolution work that I do to be able to just call in and do that representation for people. Child support is usually a sore thumb in a divorce case as well, but at least for the party receiving it, it's tax-free. Although this is another thing here that usually those that paying it get, oh, I get this, I should get this, they get all these things. They think they should get all these things because they're paying child support. Nope, they don't. You don't get a deduction. You don't necessarily even get to claim the child. But you might, it just depends. But it just depends on case. And once again, case by case, so much when you're dealing with tax is facts and circumstances. Because what works for one person or one family situation is totally different for another situation. It just depends on it. Alimony, this gets a little bit crazy too, because I got a few of these that I work with where they're claiming it as income because it was 2018 and earlier before the law changed. If it's 2019 and later, it's not deductible, it's not income, which would apply to any current cases that you might be working on. So if they're getting it, so there's no tax advantage either way for anybody to do it, other than, of course, the reasons that alimony and maintenance exist. But if it is 2018 and earlier, even with that, there are certain conditions that have to be met in the agreement for it to even be considered alimony. I mean, it has to be like specifically stated, has to be a period of time. I mean, there's a few, those are the two most common things that are missing. to be able for someone to be able to deduct it that I've encountered. And it has to of course be paid. I actually have a client who brings in their alimony payments because theirs is a pre-18 agreement. Very nice sheet comes in from, I think it goes to Family Support Registry. Even alimony goes to Family Support Registry now. They get the nice report in there and very nice there. So in this case, the ex-husband is claiming. Sometimes when you're dealing with tax situations, there could be property settlements because you're dealing with property, oftentimes in divorce cases. What's the basis? Basis is always the big thing. Why is that big? When you go to sell it. What's the basis going to be in it? And it can be considered a gift sometimes when it transfers over to them, which actually that helps in the tax situation in both the federal and state. And see, oh, by the way, sometimes when you're back on the innocent spouse part, you're not only often dealing with the federal government, you're also dealing with the state of Colorado in this case. And if you get the federal settled, that'll usually take care of the state as far as taxes go, because the state goes by taxable income. And so if you reduce whatever the taxable income is the taxpayer has, the innocent spouse can usually solve the state tax problems as well. By the way. Okay. Sale of the primary home. Sometimes you sell that, sometimes you don't. Sometimes you have one spouse, you'll have one spouse. I mean, this is just an example that I've had. You have a divorce, one spouse stays in the house, one doesn't, but the one that doesn't stay still pays, still pays the mortgage. There. He's paying the mortgage, so he can actually claim the interest on his own tax return. But later on, one moves out of the house, the other one moves back in and remarried. But then a year later or whatever, the house sells. What happens? Who pays tax? Or does anybody pay tax? Well, this is an interesting part on sale of a home, is that as long as both of them, even though they're divorced, as long as both of them can meet the primary residence 2 years out of 5, they both can actually exclude the income. It's got to be able to meet that two-year primary residence out of 5 years. It's a quirk in the tax law, but it can be allowed, even if they're divorced later on and the home sells. And sometimes you'll have the qualified domestic relations order, the quadros. Yeah, these come up. At least I've had a few of these come through, and I've helped some individuals walk through the tax part of it, going from a qualified plan because they get awarded X amount of dollars from some type of qualified retirement plan on their spouse. But it doesn't apply to an IRA, an individual retirement account there. Now, one good thing about this in relation to the one that is receiving it, they don't have the 10% early withdrawal penalty. They just pay regular income tax when they take it. Or if they take it out, they can also roll it into their own IRA. Then it would fall under regular IRA rules, but there's some flexibility there with them. So if they decide to cash it out, they can, and they don't have the 10% penalty, just regular income tax like their former spouse would have had there. So, okay, points we've covered today. Important things: income recognition deductions for you, selection of proper business entity for tax purposes, which I can guarantee not everybody in here has the same need. Not everybody in here needs to be the same entity. So that's why that part is very important. What retirement is the best choice? Which of those ones that I showed there, the simple 401k, the SEP, which of those is best for you? I don't know. I can't tell you. Tax considerations and divorce covered some of the main areas that I encounter in that, some of the thoughts that just things for you to be aware of as you deal with these cases. That way you can do what's best for your client as well. And liability for taxes post-divorce, we've covered some of that. How those can obviously be up, down, be here, there. But in many cases, not everybody. Well, one spouse is usually, at least what I've encountered, one spouse is usually more responsible for the taxes than the other. Although in some weird cases, both of them. I mean, you got your business that you do, and I know you've encountered weird things. I've been in my business, I've encountered weird things. It's like, huh? But just when you think you've saw everything, right? Something new comes along. So, So, okay. That's about it there. Any further questions? Anything? Oh, wow. Yeah, go ahead. Mhm. Okay, okay. Was the tax return not filed? Tax return was not filed. Uh, and obviously they were married at the end of that year. But then they decided to file after the fact. Is that what you're saying? What I would probably suggest doing on that reef, at least at the federal level, is they have an option where they can actually divide up the refund. And I would, at the time of filing that, I would have them figure out who gets, like we'll say it's 5,000, and say they decide one gets 3,000, one gets 2,000. You can file a form with the tax return, and they can send 3,000 to one account, 2,000 to another account, and they never have to talk to each other. And I've had to do that on occasions on a refund like that. Yeah, it is possible at the federal level. The state's a different story, though. You're probably going to get a check or a direct deposit. So, and that's where you can actually, if you have a refund on the state, you can have the refund on the state. At least I'm not aware of the state making a change because they just made a bunch of changes this year. You could actually say, okay, say the state has $1,000 refund, and say they got a total refund of 6,000. Well, one of you can take one of them and get the entire state refund deposited to their